This webinar is part of two resources that we have developed and then with Janey Place and then put up on our web community. The first one was a web video that we have uploaded called Innovate to Prosper. And that web video covers what is innovation and how a financial institution could organize its approach to being innovative throughout its bank. It includes building a culture of innovation and how to assess and test those ideas that come in. I think this is very relevant for people at the executive and senior management levels as well as for people in human resources. So we would encourage you to log on to our video section and view that first video where we talk about building a culture of innovation. Today we will be having our live webinar on product innovation specifically. And I think Janey, as I welcome her and introduce her in just a moment, you'll understand quickly why she was just such a great person to contribute to the SBBN on the topic of innovation. So without further ado, I will go ahead and introduce our esteemed facilitator, Janey Place. Janey is the founder and sole proprietor of Digital Thinking, which she founded in 2004. Janey has held executive management positions in major financial institutions from 1990 to 2004. Her responsibilities included enterprise-wide innovation strategy and incubation management, as well as technology strategy and management, strategic investing and product strategy and development. She reported to the CEOs of Bank of America and Mellon Financial, and she was a member of the Senior Management Committee at both companies. In 2007, Dr. Place was recognized by BTN Magazine as number 5 of the 20 financial services innovators over the last 20 years. And in 2003, she was recognized as the #1 woman to watch by the 25 most powerful women in banking. So Janey, welcome. Thank you so much for helping us put these materials together, and I hand it over to you.
I will wish you all a very good day. It's quite early here in New York City, but I know you're from time zones all over the world. We're going to talk about small business banking product innovation today, how to do it, what your bank can borrow from other banks, and how your banks can take steps to create a culture that encourages innovation. My banking career has always involved innovation. As Liz said, thank you for that introduction, Liz, I've held executive positions in large U.S. banks, and I've been consulting to U.S. and international banks, small and large, for the last 10 years. Just a couple of examples. At Wells Fargo back in the mid-90s, I was responsible for the internet and then for small business. And I'm proud to say that the people who followed me in those roles have done a fantastic job, and now Wells Fargo's small banking business is almost entirely internet-based, and this reduces the cost for the bank and gives those small business customers innovative self-service products through every delivery channel. And in my consulting, I often work with small business banks. I hope I can share some of that experience and ideas about how to use innovation for your own bank's small business. Okay, what is innovation on slide 6? If you had a chance to view the first innovation webinar, you'll remember these 3 points. Innovation is a better way of performing processes, creating products, and delivering service. We're on slide 6 now. It's best when it's organic, and what I mean by that is it comes from within the bank. You can use consultants to help create the conditions for innovation, but they will not be your bank's innovators because they don't know your business and your customers anywhere near as well as you do. And probably most important, and I'll say this so many times you get tired of it, innovation is based on knowledge. Knowledge of processes, knowledge of customers, knowledge of markets, knowledge of regulation, knowledge of competition. All about knowledge. Innovation is an approach on slide 7. It's not just a bright idea. Some banks seem to be full of good ideas, excitement, and great teams. I was at Wells Fargo in the early 90s, and I always felt we got 110% from our people. I then went to Bank of America, and there we got about 75%. And that wasn't just a lucky accident on the part of Wells Fargo. They had empowered, creative staff members who were open to new ways of doing things. We had spirited discussions. We often argued with each other, but we felt very much a part of the same team. That was an innovative culture. Culture is really important for innovation, and unfortunately, hierarchical organizations sometimes don't excel at innovation. And what I mean by that is organizations, banks, or other types of organizations where everybody's a little careful to make sure they have the agreement of the boss before they put a new idea forward. I'll give you an example between those two banks. I was overseeing a merger. Bank of America merged with a lot of different banks. And I was overseeing a merger of one of the larger ones we merged with, and we were trying to decide whose online banking platform we were going to go with. And the head of the online banking team from the other bank said, "What does management want the answer to be?" And I said, "I don't care what management wants the answer to be. I care what you want the answer to be." And that I would even have to say that shows that they had a much too hierarchical culture where they thought what they were expected to do was come up with the right answer in terms of what their boss wanted to have happen. There are some methodologies for innovation which work very well for small business products, and we'll talk about that in a few minutes. On to slide 8, what are some approaches to small business product innovation? Well, there are two primary types that I thought about when I was putting this presentation together. And the first one is sort of easy. Most of the major developed countries, like the U.S., have adopted tried and true innovative approaches to their small business product development and their marketing and delivery. This has been going on for at least a decade. You can look to those innovations and borrow those that appear to work for your bank. These innovations should be the first place to start thinking about product innovation for your own customers. They won't all apply, but their appropriateness should be considered. The other approach is more customized. And again, it's based on knowing your customers, knowing their business, knowing your competition, and figuring out where you can develop a product that isn't already in the market and that serves customers that either you are currently serving or that are a target group for your bank. On to slide 9. As I said in the last slide, many innovative ideas for small business banking have become almost standard. Any area can be improved with innovation. Banks whose heritage is retail or micro may find this a new concept. Those that started as commercial banks will not, because they're used to customizing. A bank's small business segmentation scheme should be highly customized to its current and target customers. For example, if international trade is a growing business in a bank's market, that would make an excellent segment to develop and to design innovative products around. Sophisticated segmentation can be a challenge for some retail banks, and some small business banks have focused segmentation on asset size, on turnover, or on credit needs. These are all good, but if you can base your segmentation on the business that your small businesses are in, that might be even better, because that will help you understand that type of business and be able to design products for it. A good segmentation strategy can help align how the bank allocates its resources for product development and for sales and delivery channels. Service innovations such as the internet and mobile channels can help you reduce costs as well as improve service. And product innovations such as a streamlined credit process can be extremely important for small business. Most important, though, is really understanding your customers. CRM, customer relationship management, is a great tool for analyzing the next best cross-sell for your customer. Not every bank has a really sophisticated computerized CRM system, and other sources of customer information like a credit bureau may be scarce in a particular country. But placing high value on knowing all you can about your customers is always a good strategy. Streamlined credit processes are probably one of the most important things you can do. Small businesses need a different process from what you would do for corporates. It needs to be faster, it needs to be lighter weight. But there can be some real advantages in working on that because small businesses can be relatively price insensitive if the lending process is fast and relatively simple. When we talk about customized products, a good example of that is supply chain finance, for example. If you have a lot of customers who are in the distribution business or in the transportation business serving larger customers, then that gives you an idea of what kind of products will appeal to that segment of your small business customers. So let's move on to slide 10, and we have a poll question here. And this seems sort of obvious, but why should you innovate around small business products? Is it to add value to the product for the customer? Is it to increase revenue or profit? Is it to decrease cost, time, and inefficiency? Is it to compete more effectively? Or is it all of the above? Think about initiatives in your bank that have these goals. Were they innovative, and did they succeed?
17% of you said that you should innovate small business products to increase revenue or profit. Nobody said to add value for the customer, to decrease cost, time, or inefficiency, or to compete more effectively. And 83% of you said all of the reasons above. So thank you for participating.
That's very good. That's a good poll. Every innovation won't address all of these reasons, but in fact, all of the above is the one I would choose. And I'm going to give some examples a little later of what might happen when a team only focuses on increasing revenue or profit when they choose to innovate. So we'll get to that in a few minutes. So let's go on to, actually we're going to get to that right now. On slide 11, innovation can have impacts that may not be fully understood at first. And I'm going to use U.S. banks as an example here. U.S. banks did a lot of product innovation to increase revenue and profit in the last decade. In many cases, this so-called innovation backfired because however successful it was at increasing revenue, and it really was, they failed to understand the impact of raising revenue from fees that added no value for customers. Many of these innovations are now correctly considered customer abuse, and there are new U.S. regulations and laws to stop these innovations, and they were described as innovations within the banks. What were they? Well, offering a free checking account or current account and paying for it by charging big overdraft fees and then making it very difficult for customers not to withdraw their account because they wouldn't show them what their balance was. So people could incur a $35 overdraft fee on a $5 debit card transactions. They would also process checks and debit transactions in an order to maximize the number of transactions that were over the account balance and not warning customers that they were in danger of incurring these fees. That made a lot of money for the banks, but it cost a lot of money for customers, so was adding no value at all. In fact, it was subtracting value for the customers. They would also shorten the time consumers had to pay their credit card bill after receiving it to less than 15 days, and then charging a very hefty late fee. Some banks actually received the payment but refused to record it until they got around to processing it, which might be a few days later, allowing them to charge an overdraft fee. And this made them a lot of money, but it really made customers unhappy, and banks in the U.S., for many reasons, but this is a big part of it, now have a very, very bad reputation. So bottom line is, innovations must be done with the customer's interest in mind. Innovation can and should be a win-win for the bank and for its customers. On to slide 12. What innovation is not? Innovation isn't genius. You don't hire an innovator and expect him to come up or her to come up with good ideas. Really, it's very hard work. It's not increasing profit without improving a product or service or technology or process. It's not a bright idea in a vacuum. There's a million bright ideas out there, but to really result in innovation that benefits all the parties to it, it needs to be analyzed, optimized, tested, and implemented well. It's not marketing schemes that decrease fees to one segment and increase them in another, like I described with so-called free checking. And above all, it's not taking advantage of your customer, which is what U.S. banks did a great deal of. So on to slide 13, what are the goals of business innovation? There are no unique set of reasons to offer innovative products, but some of them are to surpass your competitors. And so that shows you can start with, what are your competitors doing? What could you do better to uniquely benefit your customer? And that's where you might look at a small business segment and realize that the credit needs of your agricultural customers, for example, are very different than the credit needs of your trade finance customers, because agriculture gets one big payday a year, or maybe two, depending on the crop, but their credit needs are very different. Innovation can be to lower costs for the bank so that you can offer a product at a lower price point, or you can offer a very valuable product and make more profit from it. You could simplify to decrease processing time and complexity, or you could incorporate new technology into a product design. And of course, you always want to be looking to increase profit. You can be trying to acquire new clients. For example, if you see there's a lot of a certain kind of business activity in your area. For example, in India, certain sections of the country specialize in certain types of manufacturing. I believe Gujarat specializes in automobiles. So if you're going to set up a bank in Gujarat, you may wish to tailor your small business banking products to that segment. And you, of course, always want to increase your share of your customers' wallets. And that might mean offering a higher paid deposit product to your customers who are very good loan customers. You can increase your retention of customers by making them very happy. And the best way to do that is with products that really cater to their needs. But most important, innovation must fit into a bank's strategy. If a bank takes a lower fees approach to small business banking, It'll probably invest in lowering its costs through utilization of alternative channels and streamlining processes, and not invest in creating a whole bunch of new products. On the other hand, a small business bank may elect to innovate for its customer segments and develop product suites for each of those segments that allow them to charge more and make customers very happy because the products are so uniquely suited to their needs.
Janey, at this point, we did have a question come in. One of our participants asked, can we consider repackaging as an innovation, i.e. bundling offers of financial products? Do you have a quick response to that?
Yes, I think that is absolutely innovation, especially when either those products work particularly well together. For example, you have a deposit product which acts as the security for a loan, or that the bundle costs less than each individual product would cost. So you're adding value to your client by lowering the cost, but also by offering your client a bundle, you are hoping that they will utilize all of the products in that bundle that they might not if they were buying them individually. So yes, absolutely. Very good question. Thank you. Okay, on to slide 14. Yes, some approaches you should keep in mind when you're thinking of product innovation. First, explore everything. In other words, explore what other banks have already done, see what works, see if you can modify it for your customers. You know, in the U.S., we used to joke that bankers are like cattle. When one does something, all the others do it. Well, there's a reason for that. It's a regulated industry, and what you do to differentiate yourself from other banks, you don't have as full a spectrum of actions to take as you would if it was not a regulated industry. So you look at what other banks do, and then you tweak that for your own customers. You're also looking at what other banks do because that's your competition, and you have to be sure and keep up with your competition. And then, as we said, the other thing you can do is really look at your customers' needs and your market and see what you can do to meet a need that isn't being met. Lastly, and this might seem a little counterintuitive, but you need to keep your bank's infrastructure, processes, customer knowledge systems, and risk management modern, healthy, and strong so that all of those necessary components can support your team's innovative ideas. It's not valuable to have a great idea that depends on having a mobile channel and have your IT department say, well, you never told us you wanted a mobile channel. You really need to keep the core systems very strong so that the bank is always ready to move on an innovative idea. On to slide 15. Okay, what are the prerequisites to innovation? The first is develop a culture of innovation, a bank-wide culture, and we'll talk a little more about how to do that. Organizing for innovation, and that might mean things like having a process for assessing and testing new ideas with relationship managers, with customers, with prospects, as well as assessing organizational readiness, such as operational and technology capacity. We just talked about that. Another way to organize for innovation is have interdisciplinary innovation brainstorming meetings. So you have someone from product, you have someone from risk management, you have someone from marketing, you have someone from IT, and you talk about, well, this client would like, for example, a much faster credit decisioning process. Can we do that? Have everybody in the room who has a stake in that, and then talk about it. Can you come up with an answer that is going to meet the requirements of the credit department, which will probably be the toughest if you're trying to take out steps in the credit process, and also the relationship manager who knows the customer. And then, of course, a prerequisite is always knowing the market and knowing your clients. So let's talk about the culture. And I'm going to pose a few questions here for you to think about. Does your bank have a culture that welcomes new ideas? As I said, it's hard to innovate in one area without support from other areas. The relationship manager and product people may come up with a great idea, but if credit won't buy in or if IT can't support it, then it's not going anywhere. Is the culture hierarchical, where new ideas are viewed suspiciously if they don't come from the boss? Is the suggestion that a process can be simplified met with, we've always done it this way? I worked in a bank in India for the Small Business Banking Network, where virtually everybody I talked to had been there longer than 30 years. Now, with all due respect, they were very good people, but that's a red flag from two perspectives. One is your best ideas of how to do something differently are probably not going to come from people who have done it the same way for 30 years. And secondly, those people are going to retire. And as much as you look forward to having younger, bright people come in, you're going to lose a lot of cultural knowledge when those people retire. So I was sort of worried about what was going to happen in that bank. Do teams brainstorm with each other and with other teams about new ideas? Are customer satisfaction surveys done? I've got a bank right now that I'm working for in the U.S., and my job is to go to lost customers, customers who have left the bank, and find out why. What happens to the results? In the case of the bank that I'm working for now, the results are going to go into an analysis that I've developed that's going to be fed back into the bank as to why they're losing customers. And I'm very excited about the project. I think it's going to be great. So think about your own bank and how innovation ready it is on a scale of 1 to 5. If you answer no to any of these questions, you've identified a way to improve your bank's innovation potential. But just answering yes doesn't necessarily mean your bank is innovation ready. The whole bank culture must support innovation for the very best results. If market data isn't considered important, if the bank isn't customer-centric, it will be very difficult for even the best small business department to be able to be innovative. These are more specific to your small business. Does the organization recognize that small business is as different from retail as it is from corporate? Does small business product design and sales separate from retail and commercial? You know, this is an age-old problem. Banks in general evolution first serve either retail customers, perhaps micro customers, or corporate customers. When they realize that there's huge growth in small business and that can be very profitable business, they often say, okay, how can we serve these customers, and come to a decision that they're either much like corporate but with lower credit needs, or they decide they're much like corporate but with higher credit needs. That allows you to leverage technology, allows you to leverage products, and that's not a bad place to start. But when you really want to make small business the focus of the entire bank, or even a big part of the bank, then you really need to acknowledge that it's different. It's not just retail with more credit needs or corporate with smaller credit needs. It's different. And the consultative service that corporations get from large banks needs to be downsized a little bit and applied to small business. in retail banking, you don't really have to know much about what your customers do with their money, why they put their deposits in your bank, why they want a loan. If it's a mortgage loan, obviously that tells you something. If it's a car loan, that tells you something. But you don't really need to understand their business. If you're in small business banking, you really need to know what the agricultural sector in your country is like, because you want to be able to help your customers, your small business customers, with knowledge of the industry that they're in. And that's what a relationship manager is all about. They can't serve one or two big clients. That's not economical in the small business market as it is in the corporate market. But it still can be done. And in fact, I've asked every bank I've worked with so far, how many clients do your RMs have? And the answers I've gotten have really amazed me, up to 150. And that seems like an awfully lot. But when those customers are within a segment, then that RM can be an expert in that segment. So that's how small business is really different from either retail or corporate, and it doesn't have to sit on a different technology platform, although eventually you may want that to happen as well. That's certainly true with Wells Fargo. Do customer-touching bankers understand small business, and in particular the market segments that your customers operate in? Does your bank gather market data to understand their customers' marketplace? Does the small business banking department have business segment experts that can help sales people and RMs understand the needs of a particular market segment? And does the bank understand the value of alternative delivery systems for small businesses? These are all really important for innovating in the small business banking area. So the next prerequisite is knowing the market and knowing your client. Whether a bank is thinking about borrowing some innovation or coming up with new ideas, you need knowledge. You need really deep knowledge of your customers, much more so than you need in retail banking. You need knowledge of your bank's capabilities. Don't have an idea for a mobile product if you don't know your bank has a mobile channel. You need to know the delivery channels, the processes. You need to know the finances. Some opportunities require investment. Does the bank have the resources and the appetite to make that investment? And then, of course, there's risk. The more innovative an idea is, the more risk it probably has. And there are banks with a big risk appetite and banks with a small risk appetite. You certainly don't want to be banging your head against the wall with a new and risky product if the bank doesn't really have much appetite for that. You need to know the competition. Are you competing in a place where it's the lowest price? Do other banks advertise same-day approval? If so, do you have to compete with that? Is it functionality? Small business people tend to be very, very busy, and they don't have their own marketing departments and payables department. They have to do it all themselves. So having a mobile or an internet channel can be very, very important. And then what are the bank's expectations from its small banking business? Is this unique and profitable, therefore they want to put more investment in it, or do they just view it as one more segment? I wanted to give an example here. An African bank that I worked for had focused on commercial banking, and they wanted to get into the more profitable small business banking. They began by leveraging their corporate relationships and offering specialized products for their corporate customers' supply chain partners, those smaller companies that help the corporate customers with their distribution, their manufacturing, their transportation, and the bank could price those products for the small businesses lower because their relationship with the corporate customer lowered the bank's risk. Small business is pretty risky, at least in comparison with corporates. And they could bundle specialized products that gave these smaller businesses a lower per transaction cost because the total number of transactions could get included into the corporate account. So this was a real win-win for the bank. They could get new customers. Their marketing was easier because they began with their corporate customers, and they could offer a higher value product at a lower cost to the smaller suppliers. So that was a very smart move. And last point here, knowing your competition is critical. If you can offer a big advantage like either a better product or faster loan decisioning, you can probably charge a higher price for it. On to slide 20. We're going to run through, I see I'm getting a little short on time here, so we're going to run through an example of a business product innovation and how it might work. There's lots of other ways that it could work, but let's just try this one. The Small Business Banking Department, or the Marketing Department, does the market research and finds there's a growing concentration of transportation providers in their area, helping manufacturers and growers get their products to market, to sell, or to ports to be shipped to other countries. The bank marketing staff conducts interviews with current customers in this growing sector and with other players in the local transportation business, so they really understand what needs in this segment are not being met. And the bank marketing, or the Small Business Department, further conducts competitive analysis and learns that no competitor banks are offering this particular sector customized products or services. On to slide 21. So the SME department then might hire a couple of relationship managers or consultants who really know the transportation business. And as the Small Business Banking Management, with Executive Bank Management, reviews the information that they come up with. This is probably in the form of a proposal, and it probably has some costs, like hiring more relationship managers, having a new suite of products. And if the bank management looks at this, sees an opportunity, then the Small Business Banking strategy team comes up with a more detailed plan to capture market share in the transportation business. Then the Small Business Product Department works with these relationship managers to really understand the business and see that specialized products and a standard but streamlined credit process can address the unique needs of this segment. The Small Business Banking Product Development Department comes up with new products. The Small Business Department goes to IT to make sure that whatever is required in terms of the internet or mobile networks can reach and support the expected volume of new customers. There's few things worse than rolling something out and not being able to support the volume of customers it attracts. Marketing comes up with a marketing campaign, a pilot is approved, the RMs go out and sell the new product, and after 3 months, a review of how much business was generated indicates it's time for a full rollout. And here is something really important. The small business banking transportation sector is listed in the chart of accounts of the bank. Without that, it's virtually impossible to really track sales, revenue, profit, loss. But if it's its own separate chart of accounts and that goes into the accounting system, then all of that will be automatically reported, and management and small business banking will be able to look carefully at how fast is this growing, is it really profitable, or is cost of sales higher than our profit, which certainly happens. Throughout this whole process, the small business banking staff works with departments which will be impacted by the new products or processes, or those which must be part of the product. For example, credit must be very involved in a new streamlined credit process, and IT must be prepared to roll out a new channel. A cautionary note. Watch out for unintended and often harmful impacts of innovation, particularly impacts on customers, which we've talked about already. Sales and credit functions have an intentionally conflicting set of goals. Sales staff are into sanctioning the loan. Credit approval wants to protect the bank from risk. This is an inherent tension, and when both these functions are balanced and they respect each other, the tension is healthy and very good for the bank. And small business RMs are particularly effective in understanding the risk of a particular customer and per business, and therefore should have a role in the credit decisioning process. Now, I want to use another example here based on the work that the Small Business Banking Network has been doing to help banks and other financial institutions be successful in small business banking. In one situation, a very experienced bank with excellent staff and managers was making a big push into small business banking. They created a small business banking department. They had dedicated resources, and they were in the midst of designing products for the customer segment. But when I went in to talk to them, they were risking failure because they had made two decisions that were not going to help them. The first was not to use relationship managers, but rather have branch managers sell SME products. They had a very, very well-developed and large branch network, and they felt that that would be the best way to approach it. The second decision was to make their credit process more standard. Both of these decisions had good reasons behind them, but if the bank had explored all the impacts of these decisions, they would not have taken them, and in fact, they backed away from both of them after we talked about it thoroughly. First, the RM. Branch managers are not experts in small business banking. They approach the sale and support and loan process as though it was the same as retail banking. They didn't really have that additional knowledge of, well, this customer's in a growing segment of business in our market, so we'll take a bigger risk on him. All they knew was, does this client have the collateral? Does this client have the cash flow? Second was the credit process. The bank had recently suffered an unacceptably large number of non-performing loans, and they felt that handing the process and the credit decisioning over to the credit department was the way to fix the loan. In the bank I'm referring to, this innovation that took the RM out of the process, loan approval was now totally paper-based and was up to the credit department. This didn't work for SMEs. They require fast decision-making and less stringent requirements around collateral, if not creative substitutes for collateral, such as cash flow lending. With the credit department in charge, decision-making, even a rejection, was taking months, and fewer loans were being made. And most importantly, there was no consideration of the qualitative elements, which are critical in small business lending, where audited financials aren't often available. The bank reversed their prior decisions once those impacts began to be felt, and I'm anxious to talk to them again and see how well they're doing now. I think they're being very successful. Here's a couple of other questions on page 24 to just think about. Does your bank know why they lose customers to competition or to cumbersome processes or to less functional products or to Me Too delivery and service processes? If so, how do you know? Does every salesperson or relationship manager do lost business reports? Does the bank do an annual competitive analysis? Are there formal and informal communications with customers? Does your bank know its small customers' business and unfulfilled needs? If so, how do you know? Does it do customer surveys? Does it do market analysis? Does it do customer focus groups? All of these are things to consider when creating the conditions for innovation. There's one thing I really want to get to, and that is the idea bank concept, in which any member of staff can submit an idea. That idea is then analyzed and goes through a couple of gates. The first one might be, okay, we'll assign a staff person to work on it. The second one might be, okay, we'll fund a pilot. Having run this function at 3 different banks, I really discourage it. And I have a lot of reasons for doing that. Ideas from people who don't thoroughly understand the basics on this slide are rarely very good. And I can tell you from personal experience, the time to analyze 25 ideas, say, can be substantial. And then because these are your employees who submitted them, and you ask them to submit them, you need to provide feedback. That's very time-consuming, and I've found when you try and tell an employee their idea was not good and will not be developed, they rarely accept it. They don't believe your reasons. They're in love with their idea, like all of us are. So the idea bank, in my experience, has the potential of turning a positive, asking employees for input, into a negative, which is saying, nope, we don't like your input. So I know other people have run this and have made it successful. A few more questions here on slide 24, just to think about. Do the customer touching staff provide regular input about customers' complaints, their desires, what makes them happy? If it's a formal process, that's great. If it's not formal but it kind of happens, that's okay. If input isn't welcome, that's not very good. Does the bank understand what small business customers want but can't get from other banks? If so, how does the bank know? Do you really have the data, as opposed to, I was talking to someone at a meeting last night, which isn't bad, but having the data is better. You need to do a competitive analysis. When you hire people, hire them from competing banks if you can. Learn what those banks do and how they think about your bank, how they think about their customers. Most important are the relationship managers and it being a formal process. Customer focus groups are good. And of course, we've already talked about customer surveys. In summary, on slide 26, innovation can come from other banks' product ideas adapted for your customers. Successful innovation comes from knowledge about your customers and their businesses, about the market your bank operates in, including the competition, and understanding your bank's capabilities. A culture of innovation is critical. Innovation is a process, not a project. Celebrate successful innovation by imitating it. When I give advice about innovation, I stress 3 things. Know your business and your customers. Borrow liberally from other smart banks and other smart companies. Create a culture of innovation. I want to thank all of you for participating in this webinar on small business banking product innovation, and I hope it was useful to you. Please post your comments on the SBBN site. I'll look forward to reading them and will answer any questions. Thank you very much.
Thank you so much, Janey. I've been holding a few questions that have come in over the last few moments, and if people do want to stay online to hear those questions and responses, you're more than welcome to. The first question is it possible to launch a new product without carrying out product risk assessment, and what are the consequences of that?
Well, it's certainly possible. It's happened a lot. I mean, my examples in the U.S. are great examples of not having done a good risk assessment, and as a result, the reputation of all banks in the U.S., and certainly the biggest ones, have severely suffered. So it's possible, but it's not a good idea. You really need to hear from everybody in the bank who will be impacted by a new product. and that includes the risk people, that includes the credit people, that includes the IT people. It's just not a good idea to go forward without having looked into every aspect that the bank has expertise in and really tried to understand how that product is going to impact every area. I have something I use with customers which is called an assumption analysis. And when they're going to launch a new product, I have them identify who are the involved parties. Certainly the customer is, certainly the bank is, then perhaps the credit department is. And then I go through the assumptions that have to be true for the product to be successful. And if one of the assumptions is we understand the market well enough so that we think that there's a low risk that this product will not be heavily used, then if that assumption isn't true, then they have something to look at. This is something that needs to be true for the product to be successful.
Thank you, Janey. The next question is, do we need to separate the responsibility between selling loan products and the credit risk management function? What are the advantages and disadvantages?
Well, I think those do need to be separate because the credit process is really a control process. It's not part of a sales process. And there is that healthy tension I referred to. There's a story any banker can tell you about the relationship manager who's just dying to make a loan. I mean, he's going to get paid for making that loan, for one thing. But he also knows his customer. He likes his customer. He believes in his customer. And then there's the credit department who isn't interested in the customer. The credit department is interested in keeping the bank safe from risk. And so they look at all the quantitative measurements and they say, you know, this looks really risky. Yeah, the business is growing, but it's growing too fast. And I'm not sure that it's going to be able to continue to spit out the kind of money it has been in the last 12 months. It's only been in business for 12 months maybe. And I think this guy already has too much debt. And so there's a dialogue that takes place then. The relationship manager may say, yeah, but his family has a lot of money, and they're actually behind the debt he already has. Or, you know, yes, it's a newish business, but this guy has a track record. He has started, grown, and sold 2 other businesses in this same market segment before. So it really is a dialogue, and it sometimes looks like an argument. And there's nothing wrong with that. That's very, very healthy. And then that's why you have a certain size loan goes to the credit department for sanctioning. A higher loan might go up to a management committee. A higher loan than that might go up to an executive committee. And a higher loan than that might go to the board of directors, because this is all oversight. The most important thing with credit is having a process that you stick to. And sales is a completely different function and a completely different personality type. So yes, I would say separating them is the best practice.
Thanks so much, Janey. So the last question that we will address today is, it's a very interesting question, and I'm keen to hear your response, Janey. What innovation in products can an NBFC or non-banking financial company bring where it has to compete with banks and it cannot either offer a different variety of products, nor can it win the price war against the larger, I'm assuming larger institutions in its local market? So it sounds like they're asking Janey, you know, either what's some low-hanging fruit or what are some other ways that a smaller institution can compete in this market?
Right. I'll give you an example. In my own business, the company I mentioned that I'm doing the lost customer interviews for is quite a small bank. They're around just under $20 billion bank, And I know that sounds large, but in the U.S., that's actually quite a small bank. Very successful, did not get caught up in the, I guess we're calling it the Great Recession now. And what they do is really specialize in service. They've got two strategies that they innovate around. One is they serve high-end customers. So their loan rates are not the lowest by any means, but they cater to the high-end customer. And that may be a loan for a second home that could be in the millions of dollars. Well, they know this customer, and so they are happy to do that. And that might be at 2 or 3 points above what the regular mortgage rate is at the time, but that customer is wealthy and can pay it. The other thing they've done is really focus on the entertainment industry. So they have products around supporting stars, their agents, directors, writers, all of the folks that are involved in the entertainment industry. They have a special software platform that is just for the agents of multiple players in the entertainment industry. And that's a very interesting strategy for them, because when that agent gets a new customer, then the agent wants to put that customer on this bank's platform, because that makes it easier for him to manage all those accounts. So really focusing in on a segment, or through your great service, focusing in on the high end of whatever retail or small business market you want to go after. That's a good way for a smaller bank to compete.
Thank you so much, Janey. We do have a few more questions, and we're going to hold these. We'll be answering these on our web community. As a reminder, you will be able to download the presentation that was shared today or watch the video, as well as engage in ongoing discussions on this topic on our web community. We'll send you an email out when those resources are uploaded, probably within the next week or so. Thank you so much, Janey. I think the webinar today was very, very useful, as well as the video that we recorded on building a culture of innovation, which is on the web community now as well. So we really appreciate your expertise and your sharing this with our network. And just a reminder to our participants, Janey is listed as one of our experts on our web community. So if at any point you would like to reach out to her or get in touch with her, you can find her by logging in and sending her a private message to ask her anything that didn't get answered today, if you would like to do so privately. So we greatly appreciate your participation today. Thank you so much. And Janey, thank you so much for all of your expertise.